Good evening, TheoTrade. This is Coy Rosenblum, and you're watching the Theo Nightly video for the 10th of October, 2019. We got some news, we got some China, we got some tweets, and above all, we have some volatility. But our weekly expected move chart is keeping it in. So we'll take a look at the weekly expected move, specifically for the S&P 500, talk about some volatility, and update all our equity indexes. And we'll focus on a key pattern, which is a falling parallel trendline channel. That, above all else, and the volatility and the news and the spikes and the reversals, that's what's held the market and given us some good intraday positions and some short-term swing targets. Okay, so here is our S&P 500, and I've zoomed in the most recent activity, specifically September into October, because we're looking at expected moves. This is our TheoTrade expected move calculator. So the green, I may have your colors a little bit differently on my chart, but the green is going to be the upper weekly expected move. And the lower line, red, is the lower bound of the weekly expected move calculated from really Sunday night's trading. And this white line in the middle, you can call it the midpoint, but it's also Friday's close. So in this week, we've walked through the bounce between, of roughly speaking, 2951 and just a little bit under 2911, which is Don's gravity spot. We also see that into 2900. On Tuesday's session, we had the market pierce the weekly expected move in a gap and trend day. Wednesday's session had the market come, or the gap, back into the weekly expected move and rotate the bulk of the session around 2911. But it was today's session, actually the night of Wednesday and the morning of Thursday. You can't really see it here, but a whole lot of activity took place, volatility, and we'll focus on that in a moment. For Friday's session, given that today turned down away from Friday's close, but also the middle of our weekly expected move chart, and that again is roughly 2950, we are in the middle. So if you have any butterfly positions on, those sell butterflies are potentially down into these 2906 level, or any bull butterflies, we can't guarantee they will expire worthless because tomorrow could be a strong trend day to the upside. But that's probably a lower probability outcome. Specifically, what is the expected move for the next session? Within the SPX, this is our broader SPX contract for tomorrow's session, October the 11th, 20% implied volatility for, roughly speaking, 32 points. So don't forget that this still has a life in it. And if we look at this from that perspective, 33 points, roughly speaking, is, if we look at 2940, that takes us up just a little bit shy of that 2980, 297 level. And if we go 30 points lower, that takes us smack dab toward 2911, or maybe even 2900 again. So for Friday's session, look for these levels. If we see the market up above 295, then we can see a random expansion through this zone. I call it a pocket, but it's a zone of no resistance. So that will be a bull pathway if the market breaks above. Otherwise, consolidation within a, relatively speaking, wide volatility event. And if you're new to this type of logic, you can see how the past performed. So more than not, certainly not always, but way more than not, the market will stay within the upper and lower expected move. Just for reference, we can see the Nasdaq levels as we zoom and update those, and that, roughly speaking, is 762, and the high is just above 7,900. The midpoint is where we're closing, 7760. For the Dow Mini Futures, we're going to see the same logic, except that Dow Mini Futures did not expand outside the weekly expected move. Its levels include roughly 26,000, 26,500, and roughly 27,000. For the Russell, we do have it, just a comment, within a lengthy sideways trading range, and that trading range on the bigger picture is 1,600 and about 1,500. So this week itself, it also held the weekly expected move, and we're starting the week, or finishing the week, a little bit under that. So those are the levels to watch, the parameters to take note as we update our chart. Let me take us back to this one. I'll show you, I think, the main idea here. This is our hourly chart of the S&P 500 futures. And we're just seeing a declining parallel trend line channel, or sort of a declining structure, connecting out the highs and the lows. With very little exception, the market, when it jumps outside of these bands or trend lines, tends to be pulled back to the opposite side. That was a case this week. And in fact, that sort of frames out this week's trading session. Starting off with a sell swing away from 2960 down toward 2911, a little bit of a time spent under that period, and the most recent two sessions have taken us back inside these parallel trendline channels, stall at the midpoint, that's what the midpoint's for, and then all the way to the top. So when you're looking at your expected move, which roughly expands to here and to 2980, keep in mind the power, or at least the structure, of these targets. Now, let me also show you some fun stuff that just happened overnight. We'll take the extended hours and put them on the chart, and now we see the whole thing and how the market has played even in the overnight session between these two parallel trendline channels. And again, we're pushing into the upper spot, so that will be a pivot point or a reversal point for Friday's session. So given that, we will be dominant thesis bearish to the downside, and then alternate thesis or unexpected or short squeeze play. We don't predict the market, we just plan the probabilities and prepare for either outcome. If we knew, wouldn't that be great? But it's just simply probabilities. And that is a short squeeze pathway that triggers roughly above 2960. Similarly, just to update, just for reference, the Nasdaq levels, we'll go ahead and put these trend lines on there, connect off as many highs and lows as possible, and then we have these structure levels. Not perfect, but a good guide nonetheless. Your pivot is 7,800. For the Dow mini futures, that was a drop last week and stabilization this week. Russell is a weaker downtrend. And we can again connect off these lines and allow for the market to push away from. So these are just structural levels to watch, to trade short-term intraday reversals against them, shorting into resistance, buying into a support pivot, playing, as I might call, ping pong or back and forth. So ping pong is just playing on the table, serve, counter serve, back and forth, up, down, low to high. It's the same type of logic that we would play or plan or trade within a sideways trading channel, as Don has been calling the Volatility Box, or just a rectangle. But this time we have a little bit of direction. So we'll discuss the bigger picture at the end of the video. We're seeing the market repeat this pattern of rotation or a sell swing against a lengthy uptrend with diverging volume. So that's the first pattern we talked about. Second pattern was a little bit more intense with the volatility. And this is the third pattern, that the market pushed up to retest the high and now is trading lower. So we are back within our volatility box. Maybe we can see this clearer on the broader S&P 500. We'll take a look at that in terms of key levels to be watching. So our volatility box is roughly 293 and 283. So roughly speaking, 100 S&P points. Given that we're back inside the box, I'll go ahead and update this. We'll be closely watching this for tomorrow's session. So again, if we stay within the box, we do have plenty of reasons to go short or be a bear for Friday's session. That will again be the dominant thesis. And if we see a move above, we'll count it 2960, give it some leeway, give it a trick or trap, a little bit of spot to go up and reject. It's essentially a bull trap. Let that take place in a 2960, and then we'll go from there. So alternate thesis, short squeeze, pathway higher, dominant thesis, bear activity. You can use the same logic in individual equities. We had some other videos last week discussing a small bounce potential, and those bounces are taking place in stocks. Just one example before we conclude, in Caterpillar. So Caterpillar had its own declining trend line and a sideways support level into 118. that has resulted in at least a short term bounce off of 118. So it's roughly $3 to $4 almost above that level. And that's going to give us some intraday tactics or short-term plays for another run to the upper trend line. But as always, be careful and safe. This is Corey Rosenblum with your Theo Nightly video for October 10, 2019.